This is Trepp Wire Week in Review for week ending June 5th. I'm Martha Kocher with Trepp, a data modeling and analytics firm for the CMBS commercial real estate and CLO markets. I'm with our own Manus Clancy, Senior Managing Director, and Joe McBride, Head of C Refinance. This week, civil unrest and protests across the country. In some cases, business reopening efforts were foiled by violence and curfews. The overall jobless claims, while improving each week, are still staggering, nearly 2 million filed new claims, and the May unemployment rate is 13.3%. And tensions with Beijing persist. While Wall Street is making gains from its March lows, some economies are declaring that the COVID-19 recession is over. But clearly the recovery is only beginning. Is the worst really behind us?
Well, I know that Joe and I have different perspectives on this. Right now I'm a glass half full guy. I have to say, I think that I'm not a believer in this V-shaped recovery.
Wait, you're a glass half empty guy.
I'm a glass half empty guy. Did I say it wrong?
Yes.
All right. Right. My coffee cup is half empty, which means that I haven't had enough coffee yet. And that's probably why I'm already 3 steps behind. So I'm a glass half empty guy. I don't believe in the V-shaped recovery. I know we've seen some great economic data relative to what we were expecting this week. The data was amazing in the size of the misses that people were seeing versus what was predicted. The ADP jobs number down 2 million. People were expecting somewhere between 8 and 10 million job losses. The 13% unemployment this morning compared to 19 or 20% that consensus estimates had been looking at. So shocking in relative nature, but still huge. At 40 million unemployment claims over the last 11 weeks, that's an awful lot of people that have to go back out and re-recover their furloughed jobs or find new jobs. I think the tail will be long. I know that stock futures are firing up today after the unemployment number, and I do think that, we do know that we've seen a great rally over the last 6 weeks, but I do think that there's more bumps in the road. And when you talk about consumer spending and how much of that comes from business and how much of that comes from seniors, I think that we'll see some bumps in the road over the next 18 months.
Well, I'm a glass half full guy, and it may be because of our age gap, Manus. I think, you old fogies tend to be a little bit more pessimistic about the world. I'm looking at Manus's face. This is bad radio, but he's given me a bad look.
Stink eye.
But the stink eye. But, in a time like we are in right now, where there is very, very little positivity in the world, in the news, I was just looking for some very, very small glimmers of hope while we were getting ready for this podcast. And they may seem trivial, and they most likely are trivial in the grand scheme of things. I still wanted to point a few things out. So first of all, I got a text from my haircut guy who says they're reopening next week. So in terms of the very small universe that Joe McBride lives in right now in quarantine land, I'm going to be able to get a haircut next week, and that's great. I think I'm going to give them $100 because I missed the last couple months of haircuts, and they've missed out on the tips over the last couple months. So we're going to do our part for the economy. The driving range, again, very specific to my life, but the driving range is packed. Everyone's got their mask on, but you know what? I saddled up next to, an older fellow yesterday, and he gave me that look like, can you believe we're still doing this, man? And we had a nice conversation. I made a driving range friend, and, I think those little, positive social interactions that do happen, even though there are so few, give me a little bit of hope that, everyone's out there kind of plugging along and getting through this thing. And, we'll talk more about the economic side of things, but, seeing this jobs number come back at 13.3 down from 14.7 when a lot of people were expecting us to go all the way to 20% before we started to get better. You know, even though 13.3 is a bad number and like in the grand scheme of things historically, I think this is a really good sign for, you know, the next couple of months.
Well, I've never felt older than hearing that there are haircut guys out there and they text, and I don't have a haircut guy texting me. You know, to be fair, I'm one of the guys that, you know, walks into the place, grabs the New York Post, sits down in the faux leather chair. You look at everybody around, you try to figure out who's next. You know, there's 4 chairs there.
Try to position yourself to get the guy who actually can cut your hair and not the 95-year-old.
That's the ideal. And you're just waiting for, you know, somebody to yell out next. And that's it. And so, yeah, I feel like way behind the curve, not getting texts from my hairstylist, who I call a barber, in this environment.
You're hoping
for your green.
You're hoping for Tony fingernails.
Oh my.
All right. You know, part of my mood, however, may be influenced by the fact that I just repositioned myself. I'm a lifelong New Yorker, but for the last 11 weeks, I had been in South Carolina, rural South Carolina, so not the ocean coast, sparsely populated. And it's a different world down there. You would not know that there had been a COVID problem. I would say that maybe 5% of the people wear masks down there. Golf was still open. Restaurants, you know, even though they were only doing takeout, they were doing good business. People would sit outside and have a cocktail on decks. So the economy was, I would say, fairly buoyant down there. There was optimism. People would have conversations, especially because you didn't have masks on. You know, coming back to New York and having been here for a few days now, and seeing, you know, 90% masks and much more social distancing and fewer conversations, it definitely led me to believe that we are living in a state of 2 separate economies. There are the inner cities where COVID was ravaging, which I think will be slow to return and are still very nervous. And then there's big parts of the country where things are coming back very quickly. And the two seem to have very few similarities to each other.
So let's look at some of the numbers in May. We saw the biggest jump in the monthly CMBS rate since 2009. What does that tell us?
Well, it's we talked about this over the last couple of weeks. You know, we talked about the haves and the have-nots across every part of the economy, right? You know, the haves are the people that are still operating, so lawyers and accountants and so forth. The have-nots are the waitresses and the you know, the Uber drivers and so forth. You know, in the CMBS world, the have-nots are clearly hotel owners right now who have just been devastated. 20% delinquencies right now. When you add up the percentage of loans that are either with a special servicer or on watch list, you're at about 50%. And when you talk about a long tail, if we are looking at a long tail recovery, you know, these 90-day forbearances will just not be enough. Retail hit hard too. You know, 10% delinquencies there, a lot of forbearances being sought. It's an area where there were already systemic problems in terms of bankruptcies in inline stores and department store closings. We saw another big number yesterday with JCPenney last night announcing 154 store closings out of bankruptcy. And if we have more time later, we'll talk about that. But the haves would be guys in the industrial sector, offices where delinquencies are up, but modestly so, and they seem to be muddling through.
Yeah, I would just say that, you know, looking at the delinquency report, which went out earlier this week, we actually got a lot of you know, coverage on CNBC and Zero Hedge and some other places on this. That usually happens when you have such a kind of a high headline number. 4.98% is 30 days delinquent, right? As opposed to, what was it, around 7 7.15% total. So 2.15% of the universe is, I would call, severely behind. So that number gives me a little bit of solace in that, if I'm looking at things, and from a positive lens, which I'm trying to do, to offset Manus's glass half empty or full, depending on how you take the metaphor, that 5%, I'm hoping that a lot of those loans end up with forbearance agreements, or maybe they go 60 days, but then they start to recover as the economy starts to open up again. So, it'll be interesting to see. I think the delinquency rate historically has followed the unemployment rate almost right on, right? Like if you look at the chart historically, they look almost exactly the same, right? We peaked at 10.34% the last time around, and it usually lags unemployment rate. So maybe we see this, maybe we can flatten the curve on the delinquency rate here, given the fact that, the economy is starting to sputter to a start again.
It was funny as I was driving back, as I said, down south, it's a much different world, and you don't have nearly the concerns that you have up here. And when I got in the car, my wife and I were bickering over what we should listen to. On one end was Celine Dion and the Beach Boys as one person's choices, and on the other side
those were yours, right?
Those were mine. And the other side was, John Mayall and the Blues Breakers, or the Paul Butterfield Band. And we ended up settling in the middle with Johnny Cash. So we went through Johnny Cash as we went through Tennessee and West Virginia, and it was a compromise. And then when we got here, it was much more about, wow, I can't believe we were arguing about music. And now, where do you put the stinking masks and the hand sanitizer and the toilet paper and everything else? So we went from arguing about nothing to having to deal with things that were a little bit more serious in the course of a couple of hours.
Well, first of all, you should have listened to every Trepp Wire episode over and over and over again. That's your duty as a podcaster. But I will give just a little tip to our audience, especially those who really do enjoy podcasts. Dan Carlin's Hardcore History, one of the best history podcasts out there. He drops an episode once every 4 months, and he just dropped one yesterday or the day before. And it's about World War II and Japan and all that other stuff. So highly recommend for you after you listen to the Trepp Wire podcast.
I love Joe Schilling for our podcast, and I know he's not going to rest until we get guys that are selling those non-stick frying pans, as advertising to our podcast. So, or the,
like seal tape,
Gorilla Tape, or those sunglasses, the military grade sunglasses.
Anything that's sold by Billy Mays late at night on TV, I want to be advertising on our podcast.
There you go.
Or Lisa Mattresses or MeUndies or any of the other classic podcast advertisers. I'll take anything.
Right.
Wow, you have dreams, Joe.
There we go.
So looking at the shutdown, it hit malls, especially some of the lower rated malls, the hardest. Are they done, or can they come back?
Well, we'll run through a couple of retail numbers, sticking with the have and have not themes. Among the haviest would be Simon, which saw 85% of its rents collected last month, which is pretty good. Even better when you consider that they're suing the Gap for $66 million. The Gap is either their biggest tenant or one of their biggest tenants. So to see that they got 85% of their rents collected without the $66 million from the Gap is pretty good. Simon obviously is a Class A mall operator. Their stock got a nice bump this week from the end of COVID momentum trade. On the other end of the spectrum, you have CBL, which missed an interest payment on unsecured debt. They ended negotiations on several CMBS loans, which appear now to be headed back as returned loans for jingle mail, right? Going to REO. They, if I read the CNBC headline properly yesterday, 30% of rents were collected last month. So you do have a big bifurcation there. I think that people thought, generally speaking, that the B and C class malls were in trouble before COVID. I think now the question is, how far up the quality curve do, delinquencies and foreclosures go, right? Going back to the JCPenney thing, we did see the 154 store closings yesterday. We put out a piece this morning, 27 loans in CMBS, a couple in CMBX 6, the biggest one being the Arbor Place Mall, which backs a $106 million loan, backs a 2012 deal, and it does make up about 15% of the collateral in that deal. JCPenney was expected to close about 240 locations, so we do think that there's more to come, but the first 154 are out there.
So they would be the have-nottiest, right?
The have-nottiest,
the haviest, and the have-nottiest.
Yes.
We better trademark that.
We better trademark that.
Right.
So
we'll
I would just say,
t-shirt.
I think Martha was probably going to get there, but we did have an interview this week, which will be coming out next week, with the folks from MP Securitized Credit Partners. And it's Dan McNamara and Katie McKee, who is the proclaimed, I don't think it's self-proclaimed. I think it was a name given to her. She's the queen of malls. And they are, one of the companies or one of the hedge funds out there who has been kind of famously shorting CMBX 6. So essentially betting against the destiny of these 2012 vintage malls or vintage loans that are backed by malls. So some really good insights from them, a couple of interesting anecdotes about how they had a rule where they could literally not buy one thing from the mall if they were going to do a visit on one of these malls to kind of prove out their thesis. They couldn't buy a bottle of water. They couldn't buy a stick of gum. I actually think they didn't say this, but if it were me, I might have gone into the bathroom and turned on all the faucets and left. But I don't know. I think it shows some serious fortitude, because I know for me, there is no way that I could visit several malls and walk by 5 or 6 different Annie Ann's or Cinnabons and not stop in. I don't have that type of, dietary fortitude.
Right. You'd be leaving the doors open to let the air conditioning out, right?
Yeah, exactly.
That's right. We are talking, as we're talking about retail, a couple things. We do have a big week in CMBS this week, a lot of remittance reports coming out over the next week. We should have a better sense of what the market looks like by the end of next week. In our podcast next week, we will be giving some statistics on where things are going, and those should be big tells to see if there's some kind of leveling off of retail and hotel issues. We're not really expecting it. We think June will be even worse than May, but hopefully we're wrong in that. And we have talked about the past in the retail space about, for those thinking about going into the shark-infested waters of going long or short CMBX, how it's a very nuanced market that, while the malls have been getting crushed with bankruptcies and store closings and so forth, not everybody is. And, you're seeing really green shoots from the likes of Target and Walmart. So it's something that is really to be understood very completely on that. And as we like to joke at Trepp, that the biggest thing we look for is, are you selling food, toilet paper, or soap? And in the case of Kohl's and JCPenney, either you're not selling any at all, or you're selling really high-end soap. And for the Walmarts and the Targets of the world,
that fancy soap that you never actually use, you just put it in the dish for your guests to look at.
Potpourri, is that what you're talking about?
More of a poo-pourri guy. Do you guys know what that is?
Yes, I've.
Yes, unfortunately,
do some research.
Sadly, yes. Joe's taking us blue today. But yeah, if you're not selling food, soap, or toilet paper, you're in you're in tough times these days.
As we enter June, some of the initial 90-day forbearances will start to come to a close. What can we expect as that happens?
I think that we will see the market kind of trifurcated, if you will. What we've seen is for some of the property types where you wouldn't expect there to be problems, so offices and industrials, there were some kind of why not requests for forbearances. I think that some of those were rejected as, why are you asking for a forbearance when you're collecting 90% of your rent? So I think that, that kind of forbearance opportunity is being shut down, and you won't see that many of them, except in places where borrowers have expiring leases or maturity dates coming up. I think in the retail space, it'll be a mixed bag. I think in places where malls are opening, I think the 90-day forbearance will end, and the expectation is that things will go back to borrowers having to pay. It will be back to quote unquote normal, which unfortunately normal was not great for malls before COVID started. And then I think you have the hotel situation where I don't think 90 days will be nearly long enough to resolve a lot of these problems. I think that getting hotels back up to speed and up to 70 or 80% occupancy with decent RevPARs is challenging. So I think that you get to July or August when the forbearances end, and borrowers will be back asking for more time.
Yeah, I think we had another listener call in, I should say, email in into podcast@trepp.com, correcting or maybe augmenting some of the things we were talking about in terms of lodging forbearances. And this is Tammy from Massachusetts, who I'm actually going to talk to later today. We may have her on the podcast at some point as well. But she was saying that what they're seeing is a forbearance where the servicer allows a borrower to use their FF&E reserves to fund P&I payments for 3 months. So I think, and we had maybe said that the forbearances we were seeing were suspension or forbearance of P&I payments for 90 days, after which you have to pay it back. But I think all of these are going to be kind of on a case-by-case basis. And I think the servicers and the special servicers are working their tushies off in this environment, trying to, cull through thousands of emails, letters, requests, phone calls. So I think it's going to take a couple of months to kind of dig through all this. But I think we're just going to see it every month. We're going to see another couple hundred forbearance agreements, and we're going to learn more and more. And, the biggest hurdle that everyone faces is really just digging through the remittance reports, the watch list notes, the special servicer comments. I think CREFC has done a pretty good job, or I should say a very good job so far, of kind of getting out ahead of this and putting out best practices documents and new standards in terms of how you report. So, we're all doing our best, I would say, to figure out what's really going on the ground. But it's always going to take a little bit longer to, get something done if you're a CMBS borrower, because you have to live within the framework of the loan documents and the PSA and the rules of the deal and the trust and all that stuff. So
REMIC rules as well.
REMIC rules as well. So thank you to Tammy for giving us some good insight. We love that when listeners shoot us an email.
Yeah, I think my loose wording was calling the P&I payments something like a deferral or a forgiveness. The way we're seeing things work right now, the majority of things are 90-day timeout from P&I payments, but those have to be paid back. And those have to be paid back within 12 months with the greater of 1/12 of what is deferred each month for a year, or excess cash flow. So it's not tacked onto the back, nor is it forgiven. So I think I apologize for my loose words last week with that. And on the FF&E side and other reserves, it's a case where you could take it out as if you were taking out money from a 401k. to keep your mortgage payment, but it has to be paid back within a certain time frame. So it's not relieving the borrower of that obligation long term. It allows them to tap it to keep P&I payments current and so forth. So hopefully that clarifies things and makes it better.
Trepp also released a spotlight this week on CMBX 12, which Keegan tells us is going like hotcakes. And this CMBX 12 looks at the heaviest exposure to office. Why is CMBX 12 in the spotlight?
Well, it's interesting. We are going to do a CMBX spotlight every week for the next couple of weeks to cover everything from CMBX 6 to CMBX 13. Maybe over the summer when and if we get a vacation, we'll do the best of CMBX, or in this case, the worst of CMBX, and we'll run through CMBX 1 to 5, which was all pre-great financial crisis and was a wonderful trade for shorts and a devastating trade for longs. We started out with CMBX 12. We were inspired by a Wall Street Journal article noting that certain people were starting to short office REITs. CMBX 12 happens to have the biggest percentage of offices at 31.6%. Close seconds and thirds are CMBX 11 and CMBX 13, but they're much bigger numbers than what you were seeing in CMBX 6 through CMBX 10. So for people that want to short offices, this was a way to do it. And we highlighted how much exposure they have and what the biggest loans were backing those credits.
Yeah. And there's a reason that it's heavy office, right? Because after the first few years post-financial crisis, when a lot of deals were heavy retail, when the retail apocalypse thesis, was gaining more and more traction, CMBS issuers realized that they had to have more office, industrial, multifamily, other property types in there. They couldn't have deals that were number one property type retail. Right. And this trade, I think, is interesting because it's a longer term trade, because office tenants on corporations and leases, if there was going to be, a significant downturn in offices, it's going to take a good amount of time for that to happen, right? As leases roll over and they can't release spaces, as tenants slowly either move or fail, those things don't happen immediately. I think the retail short, the COVID thing was,
Huge accelerator
move, right?
Huge accelerator to the trade.
Huge accelerator. So,
but deals are still getting done in office from what we've seen this week.
Yes, it's quite interesting. We saw that the Durst organization nabbed a 230,000 square foot lease at 4 Times Square. It's renamed now. I think it's 151. It has a different name now, but it used to be called 4 Times Square. And, that particular property is just really amazing, as is the Durst organization. That property had the greatest comeback since Lazarus, if you ask me, in the last financial crisis. It's a huge building in Times Square. The area was having a lot of negative press over Elmos and Ninja Turtles and Spider-Mans walking on the street, harassing passersby. It was hard to get lunch because, you left your building and there was tourists everywhere. And at the same time, there was this negative press. They lost their sole tenants, 2 tenants, Skadden Arps, the law firm, and Condé Nast, the publisher, both left, leaving the office vacant at a time where it looked like it was going to be a struggle. The Durst organization whittled it back, 100,000 square foot lease after 100,000 square foot lease, got it fully leased up, defeased a huge CMBS loan to the relief of CMBS investors. And now, to kind of underscore their nimbleness in the midst of a pandemic when there is nobody in Times Square to speak of at all right now over COVID, you have them nabbing the biggest lease of the year with TikTok. So just kind of mind-boggling to me.
It's just going to be a floor full of 16-year-olds doing dances in front of their iPhones.
Yes, it's quite something, the phenomenon.
Well, looking at office further, this week we released a report with CRE data provider CompStack. What did that show?
Sure. So just to quickly go over it, CompStack is a crowdsourced lease comp data provider. They've been around for many years now, and they've really grown and done very well. We've been in talks with them for a long time and friendly, and I think it made a lot of sense. We are doing a partnership with CompStack where Trepp will be flowing the lease, lessee, effective rent, tenant improvement, leasing commissions, and market statistics through our platforms. And that's going to really flesh out and round out the information that's available on CMBS loans and properties. The report we did, we basically looked at the Manhattan CMBS office market, and we layered in maturities, debt service coverage ratios, NOIs, occupancies with the CompStack data. And we said, let's look for loans and properties with maturities in the next 2 years that also have a decent amount of roll risk, tenant roll risk. And in doing so, I think we looked at 120 and change properties, and we found a handful that covered about $750 million in loan balance that were kind of in the lower right quadrant of the graph that we were looking at, which was coming to maturity soon with a high percentage of tenants rolling. So we don't really call them out because there could be leases that are under negotiation, and there could be more positives that the data does not show yet. But for users that are clients of both firms, they would be able to do this type of analysis to look for potential leasing opportunities, look for potential distressed opportunities, refis, et cetera. So that functionality and data is going to be in the product in the next couple of weeks, and we're already seeing a decent amount of interest from clients and non-clients alike.
I think it's what we'll see now is we saw a huge turnover in data needs and the building of modeling staffs after the last great financial crisis. Everybody went back and said, we have to update our underwriting models, our default models. Later, CECL was added to the entire script. And what I think we'll see now is people will be back to square one, right? We will be back to figuring out what expenses should be because they're going to change dramatically for janitorial and other types of cleaning things, occupancy levels, what rents are, and so forth. And I think that this CompStack data will be very useful to see how these trends are going for model builders going forward, because I really think that you are tearing up the old playbook and starting with a new one.
Turning to corporate CLOs, the market for CLOs were shaken by the economic downturn, but in May benefited from an important court decision in New York that confirmed that syndicated loans are not securities. What is the impact of that?
Well, the good news is that had the decision gone the other way, you would have been adding an awful lot of red tape to the industry, and it probably would have shut down issuance for a long time, and it probably would have also made people look back and look at older deals to make sure that they're complying. It would have been an enormous amount of sand in the gears at a time when there's already a lot of sand in the gears because of COVID. So this is a big sigh of relief. I think people were expecting this kind of decision. I think that the shock would have been a decision against the industry. But it's thank goodness, right? It allows the market to continue going forward without more noise.
And with summer officially just weeks away, I know our loyal listener, Dave, is probably curious, what are the realistic prospects for summer vacation this year for you?
Well, I think Dave is probably listening to this now as he's on one of those big, giant, like old people bikes that you ride down the boardwalk with the little basket in front. He's probably listening as he's doing that on his nice morning vacation. I was, this week I was looking at things online on VRBO and Airbnb and things like that. And I don't have much experience, looking at that, but I have to think that the rates on rental houses, especially, driving distance from major metropolitan areas, they have to be pretty high, right? Because most people are not going to get on a plane for a while. Most people don't want to go into a hotel for a while. So I would think that, Long Beach and the Hamptons and the Jersey Shore and the Catskills and Woodstock and those types of places, especially for the Keegans of the world who like to go into the woods and just kind of hang out. I would think that those rentals are going to be flying off the shelves, especially now that it's getting warmer and that there's some positives in terms of, we had no confirmed COVID deaths in New York yesterday. There's a lot of positivity, but for me, I can't ever take a day off, so I'm not going anywhere.
I think we're going to find out that Keegan is finding the woods way too crowded. That, there's just too many people out there that can't distinguish a bear from a cow. I'm just hoping my summer is not filled with reading modification docs, forbearance docs, bankruptcy docs. I feel like that's all it's been for the last 60 days. It's a lot of reading legal documentation. I feel like I could probably pass part of the bar right now. If you had neighbors that needed legal advice on, getting out of a timeshare or, getting a recovery for getting bad hernia mesh or defective earplugs during the Gulf War, I could probably advise them right now. I feel like, I'm starting to speak at home in legalese. So I hope that that's not what my summer is like.
I object.
I do hope that the next time I get in the car, I do get the chance to listen to Celine Dion, that I'm not shut down. So my hopes and dreams are modest.
I think Binder and Binder are going to be giving you a call after this. We've really spanned the gamut of commercials at weird times on weird channels tonight, right? We got Billy Mays, we got Flex Seal Tape, we got who's the guy with the pillow? We got the pillow guy, and now we got Binder and Binder.
Hello.
That's
so
right.
we're covering all our bases.
Wow, we're going to get some phone calls
this week.
No sports this week. We almost made it without talking about
there
sports.
We almost the
PGA
escaped.
Tour is coming back though. All right, we got our sports.
We almost escaped. So with that, we'll close. Thanks to our producer Keegan St. Ange-May, and look for our special podcast early next week on CMBX 6. And join us at the end of next week as we look at what's happened during the week and how it may be impacting you. If you have a question, send us an email at podcast@trepp.com or look for our Twitter poll for topics. Until then, visit Trepp.com for more info and subscribe to the Trepp Warrior podcast with your favorite provider. Thank you for listening and stay well.
All right.